Mutual funds and exchange-traded funds, ETFs, are collective investment vehicles that pool money from investors and allocate it across diversified portfolios of securities. Mutual funds are generally categorized as either open-end or closed-end funds. Open-end mutual funds continuously issue and redeem shares at net asset value, NAV, allowing investors to enter or exit the fund directly through the fund company. Closed-end funds issue a fixed number of shares that trade on exchanges, often at prices above or below NAV. ETFs combine features of both mutual funds and stocks because they provide diversification while trading intraday on exchanges. These investment vehicles offer investors efficient access to diversified portfolios and professional portfolio management. Exchange-traded funds have grown significantly because of their liquidity, transparency, and relatively low operating costs. ETFs trade throughout the day like common stocks, allowing investors to buy and sell shares at market prices rather than waiting for end-of-day pricing. A key feature of ETFs is the creation and redemption process conducted through authorized participants, who exchange baskets of securities for ETF shares. This mechanism helps maintain market prices close to net asset value by encouraging arbitrage when price discrepancies arise. ETFs may track stock indices, bond indices, commodities, currencies, or specialized investment strategies. Because of their flexibility and tax efficiency, ETFs have become popular among both institutional and retail investors seeking diversified market exposure. Mutual funds and ETFs provide several benefits to investors, including diversification, professional management, liquidity, and economies of scale. Diversification reduces unsystematic risk because funds invest across many securities rather than concentrating on a single asset. Professional portfolio managers conduct research, select investments, and monitor portfolio performance on behalf of investors. These funds also offer operational convenience because investors can gain exposure to broad asset classes with a single transaction. However, they also involve risks and costs, including management fees, tracking error, market volatility, and liquidity concerns during periods of financial stress. Active mutual funds may underperform benchmarks after fees, while passive index funds aim to replicate benchmark performance with minimal management intervention. Hedge funds differ substantially from mutual funds and ETFs because they pursue more flexible and often aggressive investment strategies designed to generate absolute returns. Hedge funds are generally available only to accredited or institutional investors due to their higher risk profiles and lighter regulatory oversight. Unlike traditional funds, hedge funds may use leverage, short selling, derivatives, arbitrage, and concentrated positions to enhance returns. Common hedge fund strategies include long-short equity, global macro, event-driven investing, merger arbitrage, and relative value trading. Compensation structures also differ, with hedge fund managers commonly charging both management fees and performance-based incentive fees. Their flexibility allows hedge funds to pursue profit opportunities in both rising and falling markets. Risk management is especially important for hedge funds because leverage and complex trading strategies can magnify both gains and losses. Hedge funds face market risk, liquidity risk, counterparty risk, operational risk, and model risk. Some strategies rely heavily on quantitative models and derivatives, increasing exposure to unexpected market conditions or breakdowns in correlations. Liquidity risk can become severe during financial crises when investors attempt large-scale withdrawals or when markets become illiquid. Historical hedge fund failures have demonstrated how excessive leverage and inadequate controls can threaten not only individual funds but also broader financial stability. As a result, regulators and investors increasingly emphasize transparency, stress testing, and effective governance within hedge fund operations. The program highlights the growing importance of asset management institutions in global financial markets and risk transmission channels. Mutual funds, ETFs, and hedge funds collectively manage trillions of dollars and significantly influence market liquidity, price discovery, and capital allocation. While mutual funds and ETFs primarily serve long-term investment and diversification needs, hedge funds often pursue specialized strategies aimed at exploiting inefficiencies or generating alpha. Each structure involves different regulatory frameworks, investor protections, liquidity terms, and risk exposures. Understanding the operational structures, investment objectives, and risk management practices of these funds is essential for financial risk professionals because these institutions are deeply interconnected with banks, derivatives markets, and the broader financial system.